Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined this week by Nicole Dines. Nicole, what have you been following this week?
Well, Real Asset Media had two briefings this week. One was on CE market, and it transpired that 2020 obviously was a difficult year, but things are coming back very much so. Volumes declined by 25% in 2020, only by 20% this year, which is an improvement considering it was still a difficult year with investors not being able to travel and a lot of restrictions in place. So transaction volumes have reached 7.3 billion euros in the first 3 quarters of the year, and the expectation is that they will reach about 11 billion by the end of the year, because there's been a strong pickup towards the last quarter of the year as restrictions are eased. But the main positive thing about CE is that the expectation the foreign investors are coming back now that travel restrictions are lifted, and there's still a lot of interest in the CE markets. Investors are looking for sizable tickets on the whole, so they tend to head for Poland. Poland still accounts for 51% of total volume in CE, so very much the dominant country. One thing about Poland is that it's almost completely reliant on foreign capital. Percentages vary in the different countries. It goes from a low of 54% of foreign capital in Hungary to a high of 98% international capital in Poland. So obviously that has been an issue at times of crisis, such as COVID, when investors were not able to travel and foreign investors had been away from the market. So Poland has found itself more exposed than countries like Hungary or the Czech Republic that have a very strong domestic investor base. And in fact, this domestic investor base has been even more active in the last few months, and not only in their own country, but also doing cross-border deals. So while American, Asian, South African capital has largely stayed away because of the pandemic, European capital has stepped in, and local capital has stepped in as well in a big way. As I was saying, the expectation is that foreign capital from the Middle East, Asia, the US and South Africa will come back this year. So prospects are very positive for the region. And one interesting aspect is that one of the things that attracts foreign investors to the region is the competitive yield spread. For example, in prime office in Warsaw, we'll have a yield of 4.7%. In Sofia, it's as high as 8%, while in prime office yield in Paris or Milan would be below 3%. But one sector that has really defied this trend is industrial and logistics, which has been hugely in demand. I mean, obviously, we've seen across Europe, but in CE in particular, because it's such a crucial geographical area. And since Q1 2020, industrial logistics yield have compressed by 100 bips in the region, and by an astonishing 180 bips in Poland, and that is expected to continue because demand is so high. And Kevin Turping of Colliers said that there's speculation in the market that they could reach as low as 2%, which would be, he said, record-breaking, but not inconceivable. So this downward trend is expected to continue for another 2 or 3 years, experts at the briefing agreed. But, it all still works for investors because that rental growth is still coming. The only concern is that demand is not demand, which will continue to be high, but the rising costs, from energy, as we've seen, from rents and labor costs, which could push inflation up even further. But, an upbeat message, definitely expectation of a stronger 2022 for the region. Another briefing which Real Asset Media did this week, which was particularly exciting because it was the first, still online on the RealX global platform, but it was also in person, hosted by Corestate at their Frankfurt offices. It was on European debt, finance and investment, which again had a slow 2020, but it's really come back very strongly in 2021. And total private real estate debt volume in Europe is estimated now at 80 billion euros. The reason for the sector's growth, as we know, is that traditional banks just haven't been able to cover the demand for financing, partly because of more stringent regulations and the sort of restrictive policies they have in the credit approval process. They've been a lot more cautious, obviously, during the pandemic, and partly because of the sheer increase in the volume of demand for financing, especially for development, especially in sector like residential. The briefing was held in Germany. Germany obviously always had a very strong residential sector, but the demand for it has grown even more. There's demand for 1 million new units in residential. So there's huge demand for financing for that. At the moment, experts said 80% of financing in Germany is still done by traditional banks, and only 20% is done by by private debt instruments. In the US, which is by far the most established market with a long track record in this field, it is the other way around. The vast majority of deals are done through private debt. So there's growth potential, and investors are very interested because they found historically that private debt is a very stable asset class that generates good risk-adjusted returns. And another interesting nugget that came out of the briefing was that NPLs are set to make a comeback to Germany. I mean, it's not going to be a big wave because, as we know, German banks are incredibly cautious and disciplined and have been so throughout the pandemic. But it will be a sort of trickle of deals, not portfolios being sold off as we've seen in the past, but more single assets. And the estimation is about 40 billion euros of single assets, distressed assets that will be sold off. The expectation is that banks will watch their default-prone situations before they reach the 5% threshold that's been set by the authorities, and sort of act quickly before the issues begin, before the assets become a problem. And another interesting thing was that it was said that ESG, the focus on ESG, which we've seen, particularly in Germany, but across the markets, will lead to more distressed assets because banks are going to be even more cautious. We're going to focus on the ESG compliant and ideally the taxonomy compliant assets, which means there would be more distressed assets sort of left behind for others to pick up. It could be also an opportunity. They said that ESG is a perfect fit for NPLs because people could specialize in turning assets around.
Yeah, it was really interesting to see a number of those themes being picked up in the newsline, with L'Etoile Properties launching a new fund for broken core and potentially picking up on that point on stranded assets. And I noticed new research from Jos Tromp at CBRE saying that the rent premium for sustainable buildings might be as high as 29%. So ESG also a big theme there. Also picking up on the themes in the session focused on CE, we saw this week Macquarie investing 63 million in Polish last mile logistics, and Apollo taking a 300 million euro stake in CPI Property Group. So very interesting focus there on CE. And the theme on residential has obviously been a big part of a lot of our discussions. And this week in the UK, it was announced that Aviva Investors will partner with specialist BTR developer Package Living to create a single family rental platform with suburban homes across the UK. The 700 million project looks at first glance like a bit of a turnaround from Aviva. 3 years ago, the house view was that BTR did not meet an investor need. However, it now seems that investors are much more comfortable with single-family BTR. The move comes as Goldman Sachs also takes a turn towards single-family BTR. The bank agreed to buy up 700 single-family BTR units from developer Urban & Civic as part of a 3-year development deal. More BTR news as well. This week, KKR, the American private equity group, announced it's doubling down on its BTR ambitions in Britain by funding the construction of 4,000 luxury flats. KKR is investing 610 million alongside Apache Capital Partners, a property investment firm, to build on sites in Birmingham, Brighton and Hove and London, and it'll also look at other core cities. The flats will be built and run by Moda Living, and Moda and Apache will manage the buildings, with KKR collecting the rent. I also noticed BNP Paribas has written a 140 million loan for Brookfield-backed Uxco Group to create Europe's largest student housing project. The loan will extend Uxco's student living scheme known as the ECLA campus, which is located in Paris, to more than 1,800 beds. The campus is 30 minutes away from central Paris and serves students at the University of Paris-Saclay, with about 70% of students coming from abroad. And of course, Tuesday is MAPIC, the international retail property market, which returns to Cannes for the first time since 2019, and we'll be there covering the event. Thank you, Nicole. Thank you for watching, and look forward to seeing you next week for our regular roundup of the real asset markets.